Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Dhruv Patel and Himanshu Sahay. They're the co-founders of Arch Lending. We're going to discuss how Americans are adopting more interest in alternative assets. It is great to have you both with us. Welcome to Trade Talks. And Dhruv, I want to start with you first. Why are investments in alternative assets increasingly becoming more important to investors?
Yeah, thanks for having us, Jill. There's really three key reasons: higher returns, diversification, and accessibility. Alternative assets have historically yielded higher returns than a traditional portfolio of stock and bonds. And in fact, in a Bank of America study, 80% of young investors are actually looking to increase exposure to alternative assets to achieve desired returns. These assets also are lowly correlated to stocks and bonds, and so they tend to decrease the volatility of a portfolio, as well as provide exposure to additional geographies and sectors that may not exist in the portfolio today. And lastly, with the rise of platforms like Coinbase, AngelList, and Republic, it's easier than ever for individuals to invest in these asset classes, which were traditionally only available to higher net worth individuals. So to sum it up, essentially, alternative assets provide higher returns, diversification benefits, and they're easier to access.
And Himanshu, I had mentioned before, Americans are increasingly turning to alternative assets. What should you be doing to manage your wealth in what's a very dynamic market environment?
Absolutely. I think the most important thing is to operate a risk-managed, diversified portfolio of liquid and illiquid assets with different time horizons, especially looking for long-term growth in the choppy market that we have today. It's very important to leverage liquidity opportunities that you have against your illiquid assets to invest in more liquid assets and look for assets with a different risk profile. Further, I think you should leverage your alternative assets like crypto, equity in private companies, equity in other funds to look for opportunities to invest in more liquid asset classes like stocks, bonds, etc., and to also get cash for day-to-day cash flow. And this is where Arch Lending can be very helpful because we help you get liquidity against these asset classes to invest elsewhere. We face the same issue because we've been investing in the asset class for a long time, and we just couldn't access liquidity the way we wanted to, and we saw people around us face the same issue. Increasingly, Americans are getting more alternative assets in their portfolios, so this problem is only going to increase, and it needs to be addressed at a bigger scale.
You know, it's interesting because when you think of alternative assets, or at least myself, traditionally, you think about, okay, it's high net worth individuals, it's highly illiquid, but millennials and younger generations actually have an interest in alternative assets as well.
Yeah, that's right. I think there's a few that we've been seeing. One is cryptocurrencies, and there we've been seeing more interest, especially in the blue chip ones like Bitcoin and Ethereum, especially with everything that's been going on in the financial sector recently. And for those asset classes, it's important that individuals that invest there can access the liquidity when they want to.
It's interesting you bring up access to these asset classes because historically, you're right, they have been only accessible to high net worth individuals, but especially venture capital and private equity today are accessible to younger investors who may not be high net worth yet with platforms like Moonfair, like Republic, AngelList, and others. And you can and should go invest in them because they offer fantastic risk-adjusted long-term returns. And you can invest in values-aligned companies that you may be an early adopter of or be interested in long-term. Again, Arch provides a lot of loans against cryptocurrencies today and in the future against private equity and venture capital as well. And people should use such credit of this kind to further invest in these asset classes and increase their holdings.
Let's talk about that infrastructure more and how it works with Arch Lending, because of course, with what we've seen in the banking sector, what we've seen with cryptocurrency, you keep hearing about risk, you keep hearing about leverage and so forth. How safe are these loans that you're making?
Yeah, so they're incredibly safe, and that's because the way our infrastructure works is different than most. What happens is we store our individuals' funds with our custodian partner, BitGo, which is a US-based SEC-regulated trust, and we don't touch customer assets from there. So for the duration of the loan, these assets just sit at BitGo, and once the customer pays off their loans, they get their assets returned.
Got it. And with these assets, of course, cryptocurrency can be very volatile. I mean, it is very volatile, so
Yes.
The values are going to go up and down. How does that impact your end of the balance sheet?
Yes, it's no different than a stock-based margin loan where as the volatility happens, we manage our risk accordingly, and if the value of the assets decreases below a certain threshold, we have the ability to auto-liquidate the assets and repay back the loan.
All right. Appreciate the insight, guys. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.